Most people think the world's power lies in armies, presidents, or oil fields. But what if the real center of global power is something far quieter, something invisible, technical, and so deeply embedded in the global economy that most people never realize how much it governs their daily lives? And yet, hardly anyone outside of high finance ever talks about it. If you think that sounds exaggerated, consider this. Every time your country borrows money, every time its currency loses value, every time inflation spikes or interest rates shift, it's about influence, dependency, and a financial architecture that rewired the entire global economy. In the early 20th century, American finance was chaotic and fragmented. Bank failures were common. Liquidity shortages triggered panics. Markets were local rather than national, and the US dollar was not yet the world's anchor. Nobody then realized how powerful the Fed would become, or how the system it would nurture US debt markets would grow into a global empire. As the US financed the largest military mobilization in human history, the Treasury issued enormous amounts of debt. Suddenly, government bonds were no longer occasional tools. They were the foundation of national strategy. And because the US emerged from the war with unmatched industrial strength, entered Bretton Woods, a global agreement that placed the US dollar at the center of the international monetary system. It was that US Treasury debt became the safest asset on earth, a financial bedrock that all other nations would eventually rely upon. During the early decades after the war, US debt remained relatively modest, but something subtle was happening. And the most liquid, reliable, and transparent financial instrument available anywhere was the US Treasury bond. It didn't matter whether you were a central bank, a sovereign wealth fund, or a private investor, this was the asset you trusted. Each year, global demand grew, and with each new beer, the influence of US debt markets crept further across the planet. When President Richard Nixon cut the dollar's link to gold, the global financial system was thrown into uncertainty. The world suddenly needed a new anchor, something solid, scalable, and universally accessible. The answer wasn't gold, or oil, or real estate. It was US government debt. Instead of gold reserves, countries now held treasury bonds. Instead of storing wealth in physical assets, they stored it in US debt. What looked like a simple financial adjustment was actually the beginning of a massive global dependency. Tax cuts, military spending, inflation battles, and financial deregulation all contributed to a rising tide of treasury issuance. But what alarmed some economists actually strengthened the global system. More debt meant more safe assets meant more liquidity. And more liquidity meant stronger global demand for the US financial network. By the time the 1980s ended, the US debt market had become the heart of the global financial system, pumping liquidity into every corner of the world economy. But every empire has a moment when its true power reveals itself. When investor confidence evaporated, their currencies collapsed. And as they scrambled for stability, they discovered a brutal truth. Without adequate reserves of US Treasury bonds, there was no escape from financial chaos. In response, emerging markets across Asia adopted a new strategy, often summarized as never again. They began stockpiling massive quantities of US debt as protection against future crises. Their dollar earnings surged. And with every surplus, they purchased more US bonds. It was a cycle that strengthened both sides. Asia gained stability, and the US gained influence. Then came 2001 and 2008, two crises that should have weakened the US system. Instead, they supercharged it. After the dot-com crash, investors fled risky assets and poured into treasury bonds. After the 2008 collapse, something even more remarkable happened. The US, the country at the center of the crisis, experienced a massive inflow of global capital. Rather than undermining the system, the crisis reinforced its dominance. But why? Why would countries trust US debt even when American banks were failing and the US economy seemed unstable? No other market on earth could guarantee instantaneous buying and selling at scale without collapsing. The depth and efficiency of US debt markets created a network effect so powerful that even crisis could not break it. By the 2010s, US debt markets had become a planetary necessity. Every part of the global financial system, from interest rates to exchange rates, became tied to US debt. The market had grown so large that it effectively replaced gold as the world's financial foundation. And global rivals, including China and Russia, openly criticized the system. Yet despite the concerns, the underlying patterns repeated again and again. When fear rises, The world runs toward treasuries, not away from them. The system seems fragile, but in practice, it's almost unbreakable. Supply chains froze. But when the Federal Reserve intervened, it didn't just rescue the US economy, it stabilized the entire world. And the result was extraordinary. Within weeks, global financial markets calmed. The power center had revealed itself again. The pandemic exposed a truth many people still don't see. US debt markets are not just important, they're essential infrastructure. Like electricity grids or internet cables, they underlie the entire global economy. When they falter, the world falters. And when they stabilize, the world stabilizes. This isn't about ideology or nationalism. It's about structural dependency. But every empire invites challengers. Over the last decade, China has attempted to internationalize the renminbi, launch alternative payment systems, and create rival markets. Europe has worked to strengthen the euro's international role. Emerging economies have formed trade blocs aimed at reducing dollar reliance. Yet the results remain limited. The liquidity gap is enormous, and no system comes close to offering Treasury's combination of depth, transparency, legal protection, and global acceptance. Roughly 60% of global foreign exchange reserves are stored in dollar-based assets. Over 80% of international trade is invoiced in dollars. And global banks rely on trillions of dollars worth of Treasury collateral every single day. But the most shocking fact is this: U.S. debt markets now determine global interest rates. When U.S. yields rise, currencies fall, borrowing costs spike, and emerging markets face capital flight. When yields fall, global liquidity expands, asset prices surge, and foreign economies enjoy breathing room. It's as if the pulse of the world economy beats to the rhythm of U.S. Treasury auctions. And yet the system isn't fully understood even by policymakers. Many see rising U.S. debt as a weakness. Many worrying about default risks. Many argue the system is unsustainable. But what they underestimate is the network effect. The more global finance depends on Treasury markets, the more indispensable they become. This paradox where debt creates power rather than weakness is at the heart of the modern financial world. Still, this doesn't mean the system is unbreakable. History shows that dominant financial structures can erode. The British pound once ruled global finance, backed by a global empire. But war, competition, and political shifts gradually undermined its dominance. Could the same happen to the U.S. system? Yes, but the timeline matters. These transitions usually take decades, sometimes longer, and they require something crucial: a superior alternative. So while change is possible, it remains distant. For now, the world keeps turning around U.S. debt markets, but pressure is growing. As geopolitical competition intensifies, nations are wary of relying too much on American financial power. The rise of digital finance could open new pathways. And demographic and political shifts within the U.S. may strain the stability the world depends on. The system is powerful, but it is not invincible. If trust erodes, the shift could begin. Yet the repeating pattern is unmistakable. Each crisis strengthens the system. Each attempt to escape reinforces its centrality. Each new financial innovation from derivatives to stable coins eventually ties itself back into U.S. markets because they offer the most liquidity and legal clarity. The world may criticize the system, but it continues to rely on it. When U.S. interest rates rise, currencies weaken, import prices soar, and debt becomes harder to repay. When they fall, asset prices inflate, borrowing becomes easier, and global growth accelerates. Invisible decisions in Washington shape everyday life everywhere. So what are the key lessons from this story? First, global power today is not defined by armies or alliances, it's defined by financial infrastructure. And the U.S. debt market is the most powerful infrastructure ever built. Second, the system didn't become dominant by accident. It evolved through crises, trust, liquidity, and global demand. Third, the world may criticize the system, but it continues depending on it because no alternative matches its scale, depth, or stability. But there's a warning hidden inside all this: power based on trust must be protected. The U.S. cannot assume the system will last forever. Political dysfunction, fiscal mismanagement, or a major crisis could erode confidence. And if enough nations lose trust not necessarily in the dollar, but in U.S. governance, the shift toward alternatives may finally accelerate. Understanding it helps us understand global economics, geopolitical tensions, and the forces that shape our daily lives. And it reminds us that the greatest power is often the quietest. If you found this breakdown eye-opening, share it with someone who still thinks global finance is just about money. Subscribe for more deep dives, stay curious, and remember, the systems that rule the world are often the ones we never see.